I'm Joe Orlando. I am a director at Rimerman and Company. We're an accounting firm headquartered in Palo Alto with offices all across the North Bay. I am the head of the Business Valuation Group, and today we're going to talk a little bit about business valuation. When we value a company, we're looking at two things. We're looking at the value of the enterprise or the business as a whole, and then we're looking at allocating that value down to a per share value for preferred or common stock. When we look at valuing, the first thing we need to do is start with the valuation of the enterprise, and that has three different approaches to it in terms of common methodology that we focus on. The three methods are an income approach, a market approach, and a cost approach. An income approach is really taking a look at the business as a whole. A business may be mature and has cash flows, and you try to look at what those cash flows have been in the past, what they may be in the future. And when you look at the forecasted cash flows in the future, you want to try to bring those back and discount those future cash flows to today. And the biggest thing that you need to take into account is the risk of what those cash flows are. Now, some companies say they'll be $1 million in revenue in 5 years, so that has a much higher risk than a company that says they'll grow from 20 million in revenues to 40 million in revenues. A market approach is pretty straightforward when you think of it as a market analysis. In many ways, it's very similar to valuing your house. You want to look at the house next door to you and what it sold for, the house next door to you, what it's for sale for. And that should give you a good indication of what your house is worth. With business valuation, you look at publicly traded companies. Those are the companies that tell you what the multiples are of specific metrics. Those metrics may be revenue, it may be gross profit, but you look at different market multiples, and those market multiples are based on companies that you consider to be similar to the company that you are running. A cost approach is really for more asset-driven companies, and it's really not an approach we use in the technology space. It is, though, a reconciliation method that we use to understand what the value of the assets are on the that are not on the balance sheet. So, for example, let's just say our two methods, our market and our income approach, get to a value of $10 million, but the cost approach or the balance sheet says it's only worth $1 million. What that tells us is that there's probably an asset that's not on that balance sheet, and usually for a technology company, that's an intangible asset in terms of software or customer lists or goodwill, and just the value of a going concern. The difficulty that we have is looking at startup companies and what startup companies are worth. By definition, they don't have metrics that are based on historical numbers, so they may not have revenue. They certainly may not have earnings because they're in a cash burn mode, and so they're burning cash and not earning it. And so the difficulty of using an income approach or a market approach is that you're really not sure what metric you're going to use, because that metric is either not happened or it's forecast to happen. The way we look at it is actually a balance of the three approaches, but with a little bit of creativity and a little bit of forward thinking. So if we do have forecasts, we may look at a multiple of future revenues. We may look at a multiple of revenues that occur in 2016 if it's 2014. And what we'll try to do is take into account what the risk of getting to that point is and then discounting that. So one of the things I like to say about evaluation is it's a gray science, it's not black and white. And what we produce is not a black box exercise. You don't give us numbers and we kick out a number that's not adjustable or discussable. We will discuss and adjust when we have our conversations with our founders and the people who run our businesses that we value, because they know the business better than we do. And we're just looking at it from an independent third-party perspective, but we're also offering some guidance as to methodologies that can be used, and we're offering some expertise on how we look at things and how we may want to reconcile values so that we can provide a defendable, supportable valuation that can be used for income tax purposes or for financial reporting purposes.